This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we're going to go through and finish off the session by looking at the consideration. This is an issue, isn't it, essentially when it comes to looking at the fair value of the consideration. And the fair value of the consideration, it is what we record, isn't it, within goodwill. You know, everything that we've seen so far, we've just paid cash, haven't we? And when we've gone through there and paid cash, all that happened is that we debited the investment and we credited bank. You can go right back to the very first example that we did. Okay, we acquired a subsidiary, we acquired 100% of it, we paid an amount, so we credited bank, debited the investment. But the key thing is that you may not just go through there and pay cash. There are other ways in which we can acquire control of that subsidiary, i.e. in which we purchase the shares within that subsidiary. First one that we're going to go through and look at is a share for share exchange. Okay, essentially what happens there is that instead of paying cash to acquire S's shares, I still acquire S's shares, but instead of giving them a cash payment, I issue some of my parent shares in return. Okay, so let's just say that again. Instead of paying cash to acquire S's shares, I am issuing shares in the parent in return for those subsidiary shares. So what's happening there is, if you're thinking about journal entries, remember all the time we're looking at the debit to the investment. But what's going to happen there is that we're going to also have an issue of shares. So credit share capital and credit share premium. Okay. Again, how do we go through there and work out that debit to the investment? Well, that's going to look at, isn't it, the number of P shares issued multiplied by P's share price. So we need to take P share price at whatever each individual P share is worth, and then look at how many P shares have been issued. Again, it's something that becomes very formulaic. We have a step-by-step proposal to go through there and look at to how to work it all out. So what we do there is we calculate the number of shares in the subsidiary that we have bought. Okay, so you look at the number of shares in issue in the sub and look at the percentage of those shares that you have acquired. Okay, so if we bought 75% of 1 million, we have bought 750,000 shares, haven't we? Okay, so we look at the number of S shares acquired first. We then look at the number of P shares issued. So if I've acquired 750,000 S shares, how many P shares do I issue in response? It could be 1 for 2, 1 for 3, 2 for 5. So a lot of those figures that you see within your certificate level to do with your accounting. Okay. And then we need to go through and value those P shares based upon the share price of the parent shares. So again, that will then give you the value as the debit to the investment. And then if you record the full journal entry, you know, we're looking there, aren't we, at the credit entry to share capital and then the credit entry to share premium. Again, the credit entry to share premium will just be a balancing figure. The credit entry to share capital is based upon the number of shares issued and will always be there, won't it, at par. Okay. So if we look at the example that's spoken about there for your share exchange, okay, should work. I've got enough space there, I think, to squeeze it all on. It says calculate the cost of the investment. So the cost of the investment gets us from step 3. But there is an and. It also wants the journal entry, which essentially is our step 4, isn't it? Okay. So what have we got? Step number 1 is to work out the number of S shares acquired. Well, it says Harry acquired 80% of the 10 million $1 shares of Sally. So the number that we acquired is 80% of 10 million, which is 8 million, isn't it? That's 8 million S shares acquired. Step 2 is to look at how many P shares were issued. Well, it says that we have a share exchange of 1 for every 4. Okay, so we acquired 8 million S shares. For every 4, we issued 1. So is that 2 million? Okay, that's 2 million P shares issued. Step 3 is working out the cost of the investment. So those 2 million shares, each is it there at $3, which is there is it as $6 million. Okay, so that $6 million is what you would see is it in working number 3. Okay, the fair value of the consideration. Okay, in terms as well of the journal entry, that is essentially pulling everything together from what you have here. That's step 4. So you debit the investment in P's books, isn't it? With is it 6 million? We credit your share capital. Again, I'm going to assume that the P shares have a par value of $1, and we issue 2 million of them. So that gives me is it 2 million, and the credit there to the share premium is just a balancing figure, isn't it? That's there is it at 4 million. Okay, if you like, it's 2 million multiplied by the difference between the fair value of $3 and the par value of 1, which is 2. Okay, 2 million times 2 is the 4 million. Okay, key bit again is that the debit to the investment, as I've said, is it would be recorded in P's books, but don't forget we eliminate it because we eliminate the investment the parent has in the sub. But that is the figure, isn't it, that's used in working 3. Okay, that top line in working 3, your goodwill. And then don't forget as well here to credit share capital. So increase share capital, increase share premium, because that's a credit to share capital, a credit to share premium in the parent's books. And don't forget, when we consolidate, we record 100% of P's share capital and share premium. So we would need to adjust the share capital and share premium by those amounts respectively. Okay. So hopefully you're happy with looking at the share for share exchange. Hopefully you've reworked the example, check that you're okay with it. Maybe found the odd question in the question bank or the study text that you're using to help you through. What we're going to look at now is deferred cash consideration. So what you may do, as well as issuing shares in the parent in return for the shares that you purchase in the sub, you may also go through there and make a promise to pay cash in the future. Okay, and that promise to pay cash in the future creates a liability, doesn't it? It's an obligation to pay cash, so meets the definition of a liability from the framework. If that's the case, we need to record it. We also then need to record not just the liability, but the other side of the entry, which is the debit entry, which is the entry to, if you like, your investment. Okay, so what we're going to be doing is that we're going to be debiting my investment on P's statement of financial position, and I will credit a deferred consideration liability on the group SFP. Okay, however, the issue that you've got there is that's what we record today, even though the payment is going to be made in the future. So when we record it, we need to record it at present value. So a little bit of discounting. There's nothing going to be anything too technical or too difficult. It's usually going to be a 1 year's worth of discounting, which is what we see when we look at the next example. Okay, so what you've got there, if we look at example 8 and deferred consideration, it says calculate the cost of the investment. The cost of the investment in Star at the 1st of January 20x5. So that's today's date, the acquisition date. Now, it might not just be that the investment consists of deferred consideration. There could be other things as well. If that's the case, we need to combine, say, the cash paid today or the share for share exchange with the deferred consideration to get the total cost of the investment, the total fair value of consideration. So it says Pony acquired 80% of the 30 million equity shares of Start on the 1st of January 20x5. So that's today, isn't it? Okay. The consider was through the offer of a share exchange. So we will need to play around with a share exchange as we did in that previous example in the previous video. And also a cash payment of $1 per share payable on the 31st of December X5. So that's a deferred cash payment, isn't it? And it is deferred by 1 year. So we need to work out the value of that payment, not just in 1 year's time, but we need to discount it back to present value for 1 year using the fact that $1 in a year is worth 91 cents today, using a rate is that there of 10%. Okay, you don't need to convert 10% into 0.91. You might be able to do that from previous studies, but it will give you the present value of $1 today. Okay, right. Whilst we're there looking at deferred consideration, I think it's only right to pardon the pun, consider the deferred consideration and look at that first. So what we've got there is we are paying, is it $1 per share acquired in a year's time. So if we look at the number of S shares that we have bought, the number of S shares that we have bought is 80% of the 30 million, isn't it? So there we've bought 80% of 30 million. So we have bought 24 million S shares, haven't we? And we're going to pay $1. Is that there on the 31st of December? I think, was it X5? Okay. So in 1 year's time, we're going to pay $24 million, but we need to work that out at today's value, which is on the 1st of the 1st X5. That's what it's worth today. Now, $1 in a year's time today is worth 91 cents. So if you tap that into your calculator, should give you, is it $21.84 million. Okay. So that's, if you like, the value of the deferred consideration. Journal entries, doesn't ask for it, but doesn't do any harm. Is that you debit the investment, is it with 21.84 million, and I'll just say liability, credit your liability with the same $21.84 million. Okay, so part of the cost of investment is 21.84. If we then go through and look at the share for share exchange, again, you may wish to have a go at this yourself. If you do, stop the video and work it out and then restart. Okay, it's up to you. Remember, use those 4 steps. If you stop the video, brilliant, and got it right. Hopefully you worked out the cost of the investment is 32 million for the shares. Because remember, step 1 is to work out the number of S shares acquired. So is that 80% of the 30 million? Yes, I know we've already done it, but it doesn't do us any harm to be systematic. Step 2 is to look at the number of P shares issued. So it was there, was it 2 shares for every 3 acquired? So what you've got there is you take your 24 million, you multiply by 2, divide by 3. Does that give you, I think, is it 16 million? Okay. Step 3 is to value those 16 million based upon the fair value of S's shares. And at the acquisition date, January X5, the fair value of Pony's equity shares was $2. So what you've got there is you take your 16 million multiplied by $2, which gives me $32 million. To answer the question, you would take that 32 million and add it to the 21.84. So my cost of investment or your fair value of consideration is looking at your deferred consideration, which we worked out was it at 21.84 million. The share exchange was there at 32 million, which gives you, is it 53.84 million, which is what would appear within your goodwill calculation. The first line, your fair value of consideration, is the 53.84, the cost of the investment. Just bits and pieces to add around if you so wish, just to help you get better at this area of the syllabus. Students do tend to like it ultimately. On the share exchange, we debit the investment, don't we? Is it there with $32 million? We credit share capital with the P shares issued. Is it 16 million, assuming that the par value is $1? And then we just go through there, don't we? And credit share premium as a balancing figure. Again, is that there with the 16 million? Okay. Again, that's assuming that the parent share have a par value at $1. I think they do. If it doesn't mention it, we will just assume it. Okay. The other bit, I suppose, that we can consider, again, pardon the pun, it is just this little bit at the end. We know what the present value of the consideration was. We know it was 21.84 million, don't we? But we know it needs to be 24 million in 1 year's time. Okay, so what we have to do there is that we need to unwind that consideration to its final value. And its final value, we know, is $24 million, isn't it? So what we're going to go through and do is we're going to have to credit the liability to increase it to its final value. We're not going to touch the investment. This is all to do with discounting, and discounting involves interest. So we're going to debit your finance cost. So we're going to increase an expense in the statement of profit or loss. Okay. And what we do is to work out the expense, we take the interest rate. So was it 10% that we used on the discount, and apply that rate to the value of the liability being at present value. So what you've got here is you have a liability, is it at 21.84? That is at the 1st of January, was it X5? So to work out what the finance cost is, we take 10% of the 21.84 million, which gives me 2.184 million. That there is the finance cost. So what we would do there is that we would debit your finance cost, is it with the 2.184 million, and credit the liability with the 2.184 million. So I have increased the liability, haven't I? So what your liability will now be like, is it there at the 31st of December X5 at the end of the year? It was originally $21.84 million, wasn't it? To which I have just increased it by $2.184 million. And if you go through there and add that across, it comes, I think there's a little bit of rounding, isn't there, 21.84 plus 2.184. Yeah, it comes to $24.0 million. I know it says 24.02, but the reason why it's not exact is because did they say that it was 0.91 cents is the present value of $1 receivable in a year. Technically it's 0.909. Okay, and they've done some rounding there, and then that rounding is ultimately fed into our answer, so it's ever so slightly out, but rounding to 1 decimal place, it's fine. Okay, so we get that liability in a year's time to be 24 million. You would then pay it, credit bank, debit the liability. Key bit is that is what is done in the future. It does not impact your goodwill calculation, does it? The only thing that impacts your goodwill calculation is when you record the deferred consideration initially, and you take that debit to the investment at 21.84 million and never change it. Okay, change it at your peril. If you do, you're on a rocky slope, or you're on a slippery slope downwards, aren't you? If it was a rocky slope down, that would be even more painful as you slip and then crash into rocks and boulders on the way. Okay, so there you have it. Work it through a couple of times. I'm not sure how many questions you get essentially on the deferred consideration and the unwinding of the discount. I think you would have to be very unlucky to get one, but do make sure that you are confident with the share for share exchange. Other than that, that's the statement of financial position finished, isn't it? Woohoo! Let's move on and see the profit or loss within the next chapter. Bye for now.